Hi, welcome to this week's video blog at MonsterMortgage.ca. My name is Kristian Harris, and we've all heard the cliches, everything old is new again, or we've come full circle. Well, that also applies to the mortgage world as well. And what I mean by that is specifically related to business for self clients. Used to be, way back in the day, that if you were business for self, that the banks would only lend you based on what was on your notice of assessment. So essentially your taxable income. Banks would only look at that number and say that's what they can use to qualify you for a mortgage. Years ago though, however, 10 years ago, the banks started to change their philosophy as more and more Canadians became either business for self or independent contractors and weren't paid traditional salaries with deductions from employers. The banks started to change their programs, and basically what they did is they looked at business for self people and said, okay, we're not just going to base it on their net income, because a lot of business owners not only have expenses, but they have write-offs that allow their taxable income to be reduced. And the banks decided that they would start to implement programs for clients like this. So essentially, if you had good credit and good equity in your house, you're putting down 25, 35%, the banks would give you money, not based on your taxable income, but on the strength of your credit and your equity in your house. And they would give you the best rates, A rates. And recently, with all the mortgage rule changes, although this wasn't one of them, the banks have sort of tightened up their guidelines. And essentially, as I said, what's old is new again, and come full circle, because we're kind of back into the days where if you do not have enough money on your notice of assessment, line 150, if you can't qualify for the mortgage with that, if you're a business for self person, the bank's not going to give you the money. What they're saying is they're not going to allow you to double dip, quote unquote. If you're not going to pay tax on the money, they're not going to allow you to borrow a mortgage anything higher than your actual taxable income. So we have a lot of clients who have excellent credit, excellent equity in their house, and unfortunately they cannot get today's bank rates because their taxable income doesn't qualify to carry the mortgage. Doesn't mean they can't get a mortgage out there today. There is lenders who will provide them with financing. However, the clients unfortunately will not be getting the same rates as the client who has a provable income and qualifies for that deal. So unfortunately, it's not the best news, and it's not easy for business for self people out there. I am one of them as well. So a lot of people, I think almost 25% of Canadians fit into that category of independent contractor or business for self. So if you're out looking to buy a home, looking to renew your mortgage, looking to refinance, and you are one of those 25% who are either independent contractors or self-employed, suggest you give us a call. Maybe we take a look at the whole picture and see what can be done. Thank you very much.